Welcome everyone to our live Zoom recording talking about taxes. And we're here today to basically answer any questions that you may have regarding not just say taxes for real estate agents, but we'll call it say taxes on anything real estate in general. So that could be, for example, like HST issues or capital gains, or specifically with realtors, things like PRECs and whether it's beneficial or not to do that. So a little bit of just a bit about our firm. My name is Stephen Pettucci. Joining me is Neil Winokur and Miriam Snowbell, and we are part of RealtyTax.ca, which is the all-in-one tax solution for Ontario Realtors. What makes our firm unique is that we specialize in dealing with real estate agents. So that gives us a unique approach in handling each realtor's individual situation, and it gives us a better understanding of the market. As I said, we hope to have this on Facebook Live, and instead we had some issues. So what we will do is that this will be a live recording, and we'll be posting that into our Facebook at the end of the session. For people that have any questions, feel free to put it in our Facebook page as a comment, and then we can answer those questions as they come about. Okay. So Neil, did you want to chat a little bit, and I'll see if there's any questions coming through?
Yeah, sure. So Stephen, you can monitor the questions in our Facebook group and in the event page. So those two places.
Perfect.
And until any questions come in, I think the most pressing issue that we want to discuss about real estate agents is these new corporations, these PRECs, personal real estate corporations. This is probably the tool that will allow the biggest tax savings over the long term for agents with higher incomes, and even agents who might not be in the highest tax bracket might still be able to benefit from these. So we'll talk a little bit about a PREC. I don't know why they chose the name PREC, but that's what it is. So Personal Real Estate Corporation, PREC. And what this allows you to do as a real estate agent is you create this corporation, which is a separate legal entity from you as an individual. And what that means is all your commission income goes into your PREC instead of hitting your personal tax and into your personal hands. And the advantage of that is because, as you know, in Canada, the personal tax rates are so high. So in Ontario, for example, if you hit $216,000 of personal income, you start to pay over 50% tax, 50. And most people don't like paying, more than half of every dollar they earn to the government. So what the PREC allows you to do is your commission income goes into your PREC, and the tax rate on your commission income inside the PREC is only 12.2%. On the first $500,000 of profit within the PREC. So there's a big difference between 51 and 53% and 12.2%. So you could realize very significant tax savings every single year if you are able to leave profit within your corporation and not pay it out to yourself personally. Now, obviously, every individual, every realtor has personal expenses they have to pay for. So you have to pay for your groceries, your rent, your mortgage, whatever personal expenses you have. You'd have to take that money out of the PREC, pay yourself personally, and we record that as salary or dividends, and you still pay personal tax on that. But the advantage is you might be making more money than you actually need for your personal use. So if your income is $200,000, but you only need $100,000 for personal use, well, now you can show a salary to yourself of $100,000, leave the other $100,000 in your PREC, in your corporation, and you pay a much lower rate of tax on that extra $100,000. So the PREC is, if you're a real estate agent who has the level of income that is more than you need for your regular ongoing personal expenses, and you're able to save every year, you might want to consider the Personal Real Estate Corporation because of these tax savings. Now, if your level of income is such that you need all of it every year, like let's say your income is $80,000 a year and you need all of it, and you would have no leftover savings each year, then for you, like in that situation, it might not be so advantageous. But as your income goes up and as you sign more deals throughout the year, this is something to consider and to keep in mind.
Mhm. Thank you for sharing. One thing that I also wanted to bring up as a separate topic that we've been getting from quite a few realtors on, not only in our with the clients we currently have, but even just ones on Facebook, is questions about principal residence, right? And when you dispose of a property, does that trigger capital gains tax? So, as many of us already know, when you live in your current house, and you sell it, typically you do not have to pay capital gains because you would have lived in that property, and you get to claim what we call the principal residence exemption. But what happens is there's situations where people, what they'll do is that before selling their property, they may decide to rent it out for a certain period of time, and then they decide to sell that property. So then the question is, could you be basically sheltered? Like basically, would you still be eligible to claim the principal residence exemption even if you rented out that property while it was being uh, rented, or even the period before when you owned it? During that whole period, could you claim the whole thing as basically, could you shelter the entire gain? The answer is it actually depends. So what normally happens is that when you have a principal residence where, let's just say, you technically turned it fully into a rental property, then what that means is that now you have what we call a change in use. So what the CRA expects you to do, many don't catch on this at the time that it happens, but what they expect you to do is actually report a deemed disposition, right? Now, what happens is that deemed disposition for the period that you owned that, or sorry, that you lived in that property, that will be subject to principal residence exemption. But the period after that, where you started renting it out, then that's treated like a separate investment property, right? So what that means is that any gains that happen between the time that you converted it to a rental property and when you ultimately sell it, that is now subject to capital gains tax and needs to be reported on your personal tax return um, in the year that you sell that property. One way around it that we often advise our clients, or we at least ask about, is to say, well, how long did you actually rent out that property? If the situation is where they rented it out for less than 4 years before ultimately selling that principal residence, then you are able to actually file an election. It's called 45 sub 2. And that basically what it allows you to do is extend that principal residence exemption by 4 years. So the benefit of doing that is that you get that ability to actually extend the full, um, basically that whole amount of gain that was accrued on that property during the time you lived in it, plus the time that you rented it, you can actually shelter it fully. Now, there are some implications of that, so it doesn't apply to everyone. One being is that you cannot claim CCA on that property. So sometimes people rentals, as soon as they start showing in the rental income, they're saying, oh, okay, I want to deduct all my expenses against it, and they include capital cost allowance. If you did that, you're not allowed to do that kind of election. But generally speaking, it's one of those things where you are able to claim the principal residence exemption on the property, even if you did not live in that property during that period of time that you were renting it. So I just wanted to mention that is something that's we've seen. And then we even saw a comment come in yesterday where basically what happened is someone had a rental property, and then now they're wanting to live in it. So the question is, okay, do we have something that could also work with that situation? And there is another similar election where you get to basically move the principal residence exemption back a certain number of years in order to basically shelter more on that gain that was on that property. Okay, do we have any questions that came in so far? I don't believe I saw anything yet. I see we have another visitor, Tom DeLuca. Thank you for joining us. Charlene asked a question saying, what is the cost of incorporation? So that's a very common question we get as well. Now, we're talking about specifically with PRECs for realtors. With our firm, we do actually work with a separate law firm that actually helps us with the incorporation documents. Since we're accountants, we don't do that work directly ourselves, but instead we work with another law firm. Right now, I believe, Neil, did they charge us $1,750, including HST and disbursement?
No, I think it's a bit Less than that. It's going to be about,
It's
hold
between
on.
15 to 1700. I think we recently just.
Yeah, wait. I'll tell you exactly. 1 second, I remember. It'll be under it'll be basically about 1,500, and that's the fee that the lawyer is charging our clients. It's a favorable rate that includes the legal fee, and it also includes the government fees. So the Ontario government charges about 400 $400
Yeah.
for the incorporation. So that includes everything. It's all inclusive.
Yeah.
So I just got a question from someone else. I think it's just about the Zoom link. Okay, I'm just going to send her the Zoom link. All right.
Perfect. And actually related to the incorporation, that's a very interesting point that we often sometimes get from other realtors that are interested in setting up a PREC, is the question regarding not only the cost, but what kind of corporation can you have? Could it be, I'll get to your question here in 1 sec. The question is, could it be basically a federal corporation, or does it have to be a provincial corporation? Well, basically what it is that it needs to be a provincial corporation by Ontario law. So if you set up a federal corporation, so how's your PREC, that's technically not allowed under the regulation. So you would have to open up, unfortunately, another separate corporation. Aaron, I saw you raise your hand.
Yes, hi, my name is Aaron Kroll. I'm with Kroll Real Estate in Toronto. So just in regards to the PERC, is there a magic number where that would, let's say, make sense to realtors that after a certain amount of earnings that actually would make sense to form, or does it vary based on expenses and personal situations?
It really varies based on each individual realtor's situation. Okay, so there's no specific magic number, because like, here's how you look at it. There might be one realtor who, let's say, might earn commission income, let's say commission profit after their business expenses, let's say of $400,000. Okay, so you would think for sure they should incorporate. But what if that individual realtor happens to live a very expensive lifestyle and buys luxury cars and goes to casinos and spends all his or her money all the time and travels, and they spend all of that $400,000 on personal use? It must be nice to have a lifestyle like that, but that if they spend all of it, then there won't be necessarily an advantage to incorporation, right? So every realtor has to look at themselves, look at their situation, and there's basically two numbers. What is the level of income from commissions after the business expenses, right? What's their profit? And the second number is, how much of that do they need for personal use? If they need all of it, right, it could be $50,000 or $300,000 or anything in between, there might not be an advantage to incorporation. But as soon as they're at the point where they're earning more than they need, right? So let's say your profit from commission is $150,000, but your living expenses are $80,000. So that difference, $70,000, then for you, it will be advantageous to have the corporation, right? So there's no magic number that works for, thousands of realtors across the province. It really depends on your own situation. And that's, by the way, what Stephen and I are here for with RealtyTax.ca. We obviously do these free consultations, so you could schedule a call with us, and we work through your situation. We talk about it, and part of the conversation is also TFSA, RRSP, what are your future plans? Are you about to buy a house in the next 2 years and you're going to need all that money for a down payment for your principal residence, because then you'd have to take all the money out of the corporation. So there's quite a few different factors that go into this decision, and that's why it's very important for each individual realtor to get advice specific to their situation. There's no magic number.
Mm-hmm. And I think what makes this sometimes complicated for realtors to make that decision of saying, okay, incorporate or not, is that we're not like in the situation where, let's just say, your income is steady year to year, right? I mean, as being a realtor, you have high periods, you have low periods, right? It depends on market forces. It depends on how active you are as a realtor, because, there's a lot of realtors that only do these things on the side. Some do it full time. So sometimes that it can be quite a complex thing to say, okay, Should I just do this, or should I just put my money into RSPs and forget about incorporation? What I would generally say, though, to the people that are kind of concerned about, again, having income fluctuate year to year, is that corporations actually help with planning, in the sense of that when you have fluctuating income, right, you can decide how much personal income you want to show based on how much that you ultimately draw out from your corporation. The issue is that if you're not incorporated, right now, and you have fluctuating income year to year, well, your tax liabilities are going up and down. So fine, if you have the cash to be able to pay it all up front, okay, that's fine. But a lot of people, actually quite a few of the realtors that we've dealt with so far, they get very behind with personal taxes and HST, let's say 3 to 4 years. So it doesn't, and this is simply because they get thrown these massive tax bills. So having a corporation like a PREC in this case could be advantageous to your overall tax planning down the road.
Along those lines, it's also very important, and this is for every single realtor, really anyone who's self-employed, whether you're operating within a PREC or whether you remain sole proprietor. This is one of the most important things, and I write about this in my book, The Grumpy Accountant, which is available on Amazon.ca, and you can learn more about my book at grumpyaccountant.ca, which is my manifesto on how to simplify the Canadian tax system because it's such a mess. But the most important piece of advice we give our clients is that every time you receive a deposit into your bank account, whether it's personal bank account because you're self-employed or a corporate bank account because you're in a PREC, you have to really try very hard to set aside the HST that you collect, and even set aside a little bit more to pay income tax, whether it's personal income tax or corporate income tax. And that's something we advise all our clients. We work out the exact amounts that we advise them to set aside based on their situation. This is so important to do throughout the year because you might have to make tax installments throughout the year, or you have a bill at the end of the year. And we don't want people falling behind on those bills, incurring interest and penalties for unpaid installments and unpaid tax bills, because it could really add up. So we really urge everyone, open a savings account that can go with your checking account. It doesn't cost you anything extra. And every time a commission check comes in, just take the HST and set it aside. Take even a bit more for personal income tax or corporate income tax. This is so important to not fall behind on income and HST tax payments.
Mm-hmm. Definitely. And I think another interesting point that you mentioned, Neil, that I think a lot of people typically don't do initially or see the value of, is setting up those separate accounts. So what happens with a lot of realtors is, especially when they're unincorporated, is that they have their expenses across like 6 or 7 different credit cards, right? So the problem in that is that when you're trying to, it's not even just from a bookkeeping standpoint, but I mean, even let's just say if you're trying to show, let's just say the government, let's just say if they want to see proof of down the road saying, oh, did you pay for these expenses? The issue is that if you're going to show that proof, now you have to show them essentially 7 credit cards. Sometimes maybe things on there you don't want them to see, but you're still forced to show them. So even if you're unincorporated, we always recommend still having that separate credit card to have your expenses on there. And then for your personal stuff, is obviously everyone has personal expenses. I have personal expenses that I don't want the government to see. I keep that on a separate card. Now, when you're incorporated, that's even more important to have that separate account, because the corporation is a separate legal entity. So what that means is that by law, it should have its own separate bank account, and it should have its own separate credit card account. And again, we're not just saying this is just for bookkeeping purposes, but we're saying there's a legal substance behind having corporate assets and corporate liabilities. And we understand that, again, there's a lot of realtors out there that are making this transition from personal to corporation, and we see that they're still using some personal cards. Again, not to say that that you're going to be crucified if you do have a personal card that you're using, but again, you need to start putting limits on how are you actually using that account, and how to basically separate out business from personal.
Thank you, Stephen. There's something else that's been on my mind actually for the past couple of days, and someone emailed me about this as well. The government, the federal government, announced, I think yesterday, that they will finally release a budget on April 19th or April 17th next month. They will be releasing the federal budget. Now, they haven't released a budget for the past 2 years. So this is, and that's never happened before. Even every year of World War II, the federal government released a budget. And the past 2 years, we've had no budget. So we finally have a budget. And why is this relevant to us as accountants and realtors? Well, there's a lot of speculation because we know the government is fishing for new money. They have a lot of debt because of all the COVID spending. And there's a lot of rumors and speculation about two things I want to focus on. Number one, a possible new tax on the sale of a principal residence. Will they abolish or limit the principal residence exemption? There are rumors about that. I don't think they actually will. I think there will be a rebellion in this country if they try to do that. But there is some speculation in terms of what will happen to the principal residence exemption. It's interesting that our neighbors to the south in the United States, in the US, they actually do tax the sale of a principal residence. Now, there's an exemption up to $250,000 of the gain tax-free for an individual and $500,000 for a married couple. So you get that first $500,000 gain tax-free as a couple. Remember, that's $500,000 in US dollars. So if Canada were to implement some sort of principal residence tax when you sell your principal residence, I wonder if they would have an exemption amount on a part of the gain. What's also interesting in the US, they allow a deduction every year on your tax return for mortgage interest, which we do not have in Canada. And I can guarantee you that if the federal government in Canada establishes a tax on your principal residence sale, they will not allow a deduction for mortgage interest. That will never happen. So they're going to really be like double dipping. Actually, it's triple dipping because we also pay property tax every year from after-tax funds. And of course, you purchase your house from after-tax funds. So there's a lot to say about that, whether they would start taxing principal residences, but I think it's very highly unlikely. But what could be more likely, and this is the second issue, which is also relevant for realtors who like to own rental properties and flip properties, is the capital gains tax rate. So right now in Canada, when you have a capital gain, half of the gain is tax-free, right? 50% of your gain is tax-free. The other, and you only pay tax on half of the gain. So there is talk about possibly increasing the tax rate on capital gains to possibly including 2/3 of the gain in your taxable income or 75%. It's unlikely they would jump up to 100% so abruptly. About, I think maybe 10 years ago or 15 years ago, the capital gains inclusion rate was 75%. And at one point it was 2/3. So historically, we did have capital gains at higher rates. And I forget exactly how many years ago, 10 or 15 or something, they reduced it to only half. So there is some speculation that perhaps they might be looking to increase that inclusion rate. So people are asking us, oh, should I have stock that went up, should I sell it now before they increase the tax rate on capital gains? Or I have investment properties, rental properties, and the market value is so much higher now, should I lock in those gains? Should I sell those properties now when the gain is only taxable, when only half of it's taxable, instead of waiting for them to increase the rate? And we actually wrote an article about this. It's up on our website. If you go to RealtyTax.ca and click on articles, we wrote an article about this a couple months ago. And my opinion is I would not make any rash decisions right now in anticipation of a future possible tax increase, because we don't know what will really happen. If when the budget comes out next month, we don't know if this will be in the budget or not. And many people are saying at this time when the economy will be recovering from COVID, it's not a good idea to raise taxes when the economy is trying to recover. So it's possible that this is just speculation and rumors and like, will it really happen for sure? We don't know. And I would not advise anyone to make any investment decisions on selling an asset that's appreciated just based on speculation that the capital gains tax rate might go up. right? Like we just don't know. And maybe I'm wrong. Maybe it will go up and then you're going to hate me, but I don't know. It's impossible to know. It's impossible to predict. So if you think this is an asset or investment that you have and you want to hold it long term and you're earning income from it, I wouldn't rush to sell it because the government might increase the rate. We just don't know. Like we don't have that information at this point.
And just speaking historically, typically the government doesn't like to make big moves where it basically allows people to sell a whole bunch of things quickly, because that has a lot of economic implications, not even just to say people's personal financial situations. So given that, we just kind of, I wish to say we were at the end of the pandemic, but it seems like we're still almost like, I don't know, I guess midway through it or whatever. But they know that there's a lot of people that are still struggling out there. And the last thing they want is to say, okay, we're going to screw a whole bunch of the population over by implementing this principal residence tax and stuff. So again, do I have a crystal ball? Like Neil says, no, I do not. But I'm typically against as well about people who are making decisions based on speculation and like low chances of this and that happening. Right. So just something to keep in mind. One thing I also just to kind of change topics a bit, because I know we're getting into a little bit of a political discussion, but for realtors that did set up PRECs in 2020, I'm not sure if there's any in the room that did that, but something to keep in mind is that if you did do that, we've had quite a few issues so far when it comes to the T4As that your brokerage is releasing. And this is something where even if you didn't do it in 2020, something to keep in mind for 2021, if you are setting up a PREC in this year, is that we've seen quite a few errors on what the brokerage has been reporting. So one error that we've seen is, I think the first one that comes to mind is like HST was being included in the T4A. So basically, in case you're not familiar with the T-slips, the T4A is what shows your commission income. But by law, it needs to be reported on a net basis. Sometimes we've seen the brokerages report it including HST. So that's an issue, because if you report that income on your personal tax return with HST included and don't back out the HST yourself, then you're paying tax. Well, you're paying more tax than what you need to, because that HST that's in there, that's not your money. That's to be remitted to the government. So that should be netted out. The other thing we've seen as well is situations where people, or basically the brokerages, have added on commissions earned on a property that closed before the PREC started and put it on the PREC's income. So I know what I said may sound kind of weird, but basically what's happening here is that some brokerages are doing is that they're reporting income earned for a PREC before that PREC was even formulated. So that technically is against what the regulations have about PRECs. It also is against CRA's principles regarding earnings on an accrual basis. So, most people would argue saying, well, how could a corporation earn this money if the house closed before it was even started? So if you do see these things, and we always recommend, or we always tell our realtors, especially our clients, we request them to do this, is to give us a breakdown of that T4A, look through it and make sure that it actually makes sense. Don't always assume that your brokerage is doing everything correctly. Not to say that they're doing it all wrong, but it helps to have a second look at it yourself. And of course, if you're our clients, we check that for you as well and ask the appropriate questions. So just something to keep in mind there regarding tax slip reporting, as I'm sure a lot of you already got your T4As from your brokerage this year.
Sort of along those lines, actually, for realtors who switch into a PREC, the due dates for filing your tax returns are a little bit different, because right now before a PREC, if you're sole proprietor, you're probably used to filing on June 15th is your due date to file your personal tax return and HST return as a self-employed sole proprietor realtor, and your taxes payable are due by April 30th, right? So by April 30th, you pay your tax and HST, and then you have until June 15th to file your personal tax and HST. If you go into a PREC, the due dates for the PREC are different. So we like to set up our clients on December 31st year ends. And if you have a December 31st year end, the way it works is your corporate income tax payable is due by March 31st, but you have until June 30th to file the corporate tax return. So whatever year-end date you choose, you have 3 months to pay the corporate tax and then 6 months to file the return. And HST, you have to pay it 3 months after the year-end date, but you also have to file the HST return 3 months after the year-end date. And we know this, a lot of people don't realize that and they miss it. They think that the HST return is due the same as the corporate tax return, 6 months. You think the government would make it easier for small business owners and just have the same due date, but they don't. In fact, I think the HST return should be combined with the corporate tax return. I write about that in my book. But just keep in mind, if you're operating through a corporation, remember, you have until 3 months after the year-end date to file that HST return. That's very important because if you miss that deadline, even by 1 day, they slap a 5% penalty of the amount owing on the HST payable. And that could really add up, right? So you got to be careful. And just another quick thing to mention is installments. After the first year of filing, if you owed more than $3,000 of income tax or HST, then you have to pay tax in installments. Same as personal, that you're probably used to making personal tax installments and HST installments throughout the year. It's the same principle through the corporation. You might have to start paying HST in quarterly installments and pay the corporate income tax as well, possibly in monthly installments. So these are things, obviously, that when we set up our clients, we advise them on this and we remind them and we get them set up in our system.
Mm-hmm. Absolutely. If there's anyone in the room that does have questions, feel free, you can unmute or type in the chat and we'll be happy to answer your questions. Something that came to mind that I wanted to bring up and now I forgot. I think it was good. Oh, one other thing I was going to mention that we've had a couple people ask us so far too is, let's just say, we've had this come up a couple times. Oh, sorry, someone has a question here. Are we allowed to own property under the PRECs name? So that, I guess by property, do you mean like investment property in the sense of like a real estate rental, or do you mean like vehicles or stuff like that? Yes, investment properties. So the answer is yes. By law, the way how the regulations are stated, you can actually have investment properties owned by your personal real estate corporation. It's different than the laws in British Columbia because there they actually have rules. If you're reading online, you may see some conflicting information about this. But in BC, they actually say, sorry, you cannot own any like investments. You can't sell investments in the PREC. You can't do any of that stuff. Here in Ontario, they made the rules a bit more loose. So you are able to have investments inside your PREC. The only thing that we caution our current clients right now on is if you plan on buying several investment properties and then flipping them, so in the sense of making it like an active business where you're renovating, selling, renovating another house, selling, and doing that frequently several times throughout the year, there's a rule that's mentioned in the regulations, and unfortunately we haven't gotten clarity on it from either RICO or ORIA or any of those guys because they don't like to touch any legal stuff. But they basically, there's something written in the regulation that says that the PREC is not allowed to trade what they call, it cannot pursue a business of trading in real estate other than receiving commissions from the brokerage. So technically trading in real estate, that is like what you do as a realtor, but our concern is that if you're flipping properties, that could be seen as like an active business of trading in real estate as well. So if you're just saying, okay, I'm going to hold this investment property, rent it out, and then sell it, in a couple of years from now, that's not really an active business. It is passive income to you. And again, you are allowed to hold it in your corporation, but it likely would not be against what the regulations say. Now, something to also keep in mind is that it does involve a little bit of analysis to see, is it worthwhile having an investment property inside your corporation? Because we got to keep in mind there's a couple factors at play. One of them being is that if it's a current property that you own, sorry, I'm just going to add someone into the room here. If it's a current property you own and you're going to move that into your personal real estate corporation, you may have an issue paying land transfer tax because the corporation is a separate legal entity from yourself. So that's something where you probably would have to get a lawyer involved to see if there's a way you can mitigate the land transfer tax, but that could be one issue. The other issue too is that when you're holding real estate investments, that passive income earned on the rental income is subject to a 50% tax rate. It's a flat tax rate. It's basically the passive income tax rate. Actually, I'm just hearing a little bit of feedback. I'm just going to mute one of our participants temporarily. But basically what it is that, yeah, that passive income is taxed at, I think, 50.7% right now, which is pretty high for passive income. So what we have to do is determine what's a more optimal structure to basically lower that tax rate. One thing that we advise doing, just from a general perspective, is actually paying a salary from that rental income to yourself, and basically it wouldn't eliminate, you know, the 50% tax rate, but it would lower it by a couple percentage points. So there's a couple factors at play. There's also something that I don't want to get too technical, but there's something also called refundable dividend tax on hand that basically with some of that high tax rate, you get refunded if you're paying a dividend. But of course, when we talk about dividends, there's a tax plan there. So just want to say that in general, that it would involve some consultation before you just actively move rentals in your into your PREC. And also to your point too, yes, you can also own vehicles under your PREC as well. Aaron Kroll, you have I'm not sure if you have a question or you're just congratulating. Oh, sorry, I think you're muted. I can't hear you, unfortunately.
Sorry about that. I picked the wrong icon. I meant to raise my hand.
Oh, you're not congratulating us. All right. Okay, never mind.
My apologies. No, it was very good. It was very good, but as well what you said. Just a quick question, getting back to capital gains. In our experience, we're seeing more and more purchasers are turning to recreational properties. Like lots of my personal clients, our brother agents as well, like have been working in cottage country, places that we typically didn't do much business, but I think due to the pandemic, it's driven people to basically reevaluate how they actually want to live. Now, most of those people still keep homes over here as primary residences, but also are almost treating their recreational properties as secondary primary residence. So the first and most important point that I wanted to ask you is, how does this ERA look at the capital gains on that secondary property, which is actually being used almost as like a primary property now? The second part of my question is, well, it's a bit of a deviation. I'm going off a little bit on a tangent over here, but if people end up building, like they're building actually something new, it's essentially, as buyers spend, this PRA will look at it as a newly constructed product, and there would be also like a factor of HST involved there if the people want to sell it. So I guess the second part of my question is, how is the HST kind of handled by the PRA in that situation? And then getting back to the first part of my question is, how does this PRA look at the capital gains on that secondary property?
Mm-hmm. Stephen?
Yes, sir.
Can I take the first question and you take the second question?
Yeah, for sure.
Okay. So the capital gains, the way it works is, the rule is, let's say you're a married couple, right? A family. The married couple can only have one principal residence. But so in the old days, like 1970s, like when 1971 was actually when capital gains tax first came to Canada. Prior to 1971, there was no capital gains tax. When they implemented the capital gains tax in 1971, they allowed principal residences to be exempt. Now, when that first started, it was interesting. They actually allowed a married couple to each have, like what they would do was, a family would own a house in the city, and the family would also own a cottage in cottage country. And the husband would own the house in the city, and the wife would own the cottage in cottage country. And they would claim both of them as principal residences because each individual would have one principal residence. The CRA closed that loophole and basically says you can only have one principal residence, like as a couple, right? Whether married or living common law. So if many families own a house in the city where they live and they own a recreational property in cottage country. Now, let's say they sell their cottage. So they actually, what you can do, every year you owned the cottage. Let's say you owned the cottage for 20 years and you sell it. So when you sell it, you have to report the sale on your tax return. Now you could you get to choose which property you're going to designate as your principal residence. So for the whole 20 years you owned the cottage, if you owned a house in the city and you own the cottage in cottage country, and you spent time at the cottage every year, you didn't rent it out, you didn't earn rental income, like it really was your personal property, you have the choice of which property each year to designate as the principal residence. While if you owned both properties, right? Now, in each of the years, you can only designate one of the properties. So you can't double dip and claim the principal residence on two different properties in the same year. So what you have to calculate is where do you have the bigger capital gain, right? And that really depends. Most people, historically, the bigger capital gain usually would be on your house in the city. But that's actually changed recently because the values in cottage country have gone crazy, right? So what each family has to do is kind of calculate, okay, where do I have the bigger gain? Is it the gain on sale of my house in the city or the gain on the cottage? And then if the bigger gain is the one in the city, then maybe you want to save your principal residence exemption for the city if the cottage has a much lower gain. If the cottage has a higher gain, maybe you want to claim the principal residence on the cottage, but then keep in mind when you sell your house in the city eventually, you won't be able to claim the principal residence on that house for those years you already claimed it for the cottage, right? So it can get kind of complicated and messy. So definitely your clients who are buying recreational properties and they also own a house in the city, they should seek out some tax advice on this to figure out what they're going to do. Like they should do some planning in terms of when they do come to sell either their house in the city or their cottage in cottage country, they're going to have to plan this out and kind of do that calculation where, you know, which one has the bigger gain. And sometimes even if the cottage has a smaller gain, but you're selling it now, maybe you want to save the capital gains tax now, right? And then even though later on you'll have to pay on your house, well, the money is worth more to you now if you save it now, right? So there's a lot of different ways to look at it. But generally speaking, the answer to your question, the rule is they could choose which property to designate as their principal residence, but you can't choose two principal residences in the same year. So for every year you're designating the cottage as your principal residence, you'll lose the exemption on your house for those years. Does that like kind of answer the question? It makes sense?
Absolutely. Yeah, that definitely clears it up for me.
Okay.
Thank you, Neil.
Okay.
And just to answer the second part of the question regarding HST paid on basically expenses to basically build up this property. Just for clarity, is the intention where you just be living in it afterwards, or do you would you be seen in the sense of like, okay, like you have this, say, like this vacant land you bought, you're gonna build a property on it, pay the HST on your expenses, and then ultimately sell it? Is it living in it or selling it?
So it's essentially like people, let's say if people are living in it, let's say they build and they're kind of end users, they're actually living in the property, and then they eventually sell the properties. But at what point does it become actually resale versus actually new construction? Because I think like new construction there would be HST applicable on this sale, right? This CRA would have to collect HST, right?
Yeah, and I think what it comes down to, I wish I could give you a concrete answer right now, but I think what it comes down to is determining, are you a builder or not for under the HST rules, right? Because what normally happens is that when you're, what happens with a lot of builders is that when they sell the property, of course they have to charge HST, but then the buyer, if they're acquiring it for personal, they get that rebate. In certain circumstances, that the builder can also deduct the HST from the purchase price, and therefore you don't have to do the rebate. But I've seen different sides of that happening, so I think it depends on various factors. My take on it though is just for the period where, let's just say, like you're incurring those expenses, right? If I have HST in it, and then you plan on living in it. During that period, I think I think the rule is like upon like a close to 100% completion, then you get to actually perform get to complete a rebate. It's called the NRPP rebate. That one would allow you to recover the HST on your expenditures. But I think there's also some other conditions. I'm not sure if Miriam, if you want to chime in on this, but there could be some other conditions that apply. So I'd have to kind of get more details before I kind of say whether, how much you can recover of that.
Yeah, the only thing I would add to that, just in general about the rebate, is I believe you have to be moving in and have it. The rebate won't get you back all your the HST that you spent. There's a formula, it's capped, and you do your best to get as much money as you can. The more expensive the property, I believe, the less of a rebate there's going to be some grind down to that rebate. But definitely accumulate all the ITCs, all the HST you paid, so that when the time comes, you can report, on a worksheet what you've paid and get as much back as the legislation, both federally and Ontario, allow you for that rebate.
Yeah, exactly. Yeah, we find that usually in our line of work, the hardest the hardest questions come more regarding HST than anything else, because, as Neil says, we have too many books in our tax system. One of them is a whole book dedicated towards GST, HST. So we have our income tax, which is massive, and then we have the Excise Tax Act, which has been building on for many, many, many years. So, yeah, that's something we just have to look at a little more closely before we give you an answer on that.
Thank you.
No problem. Actually, just I want to actually touch on another thing that actually Rosalie had put up regarding having cars in the corporation, because I know we initially talked about having investment properties. Sometimes the question comes up too, saying, okay, I'm interested in purchasing a car, and I just set up my PREC. Should I have it should I tell the dealer to put it under the PREC's name, and therefore the PREC owns it? That is a very interesting situation. We would say is that if you're in a situation where you're like, okay, for sure you want to purchase it, you're not considering like lease versus buy, you want to buy it. It would be beneficial actually having that car in the corporation. The reason why that is because the corporation is allowed to claim capital cost allowance on that vehicle. What happens is that there's realtors right now where they have their sole proprietor, and then then they moved over to having a personal real estate corporation, but they still own their cars personally. They didn't do the plate transfers or anything like that. They kept it as is. So in those situations, you are actually allowed, as far as vehicle expenses go, you can still technically claim your gas and maintenance. I mean, there's obviously like what's called like a reimbursable limit that we would look at to see, okay, how much is it over or under. But in a nutshell, you're still able to claim vehicle expenses. But the thing that you cannot claim if you still own your car personally but have operations through a PREC now is the capital cost allowance. So having ownership, having the corporation own that vehicle, not only does it make it more cleaner for a CRA review, if they're saying, okay, you have vehicle expenses, how come if you don't own a car? You say, well, yes, I do, here it is. But also, it comes down to also being allowed to claim CCA, because the corporation must own the asset for CCA to be claimed. So just wanted to put that out there in case any of you are wondering about moving, having a vehicle under there or not. And just something else to keep in mind too, just, is that, when you're moving even say a vehicle to a corporation, there may be, as far as not even like from a tax perspective, but just from a cash outflow perspective, is the fact that you're probably going to have to pay a different insurance premium, because when you tell your insurance company, you're like, let's say if you typically said, oh, I use my car 90% personal, 10% for business, and now you have it under a corporation, they're probably going to say, yeah, I think you're using it a bit more than 10% for business. So, so that may result in higher premiums. But when you compare it to being, let's say, a sole proprietor versus a corporation, there really shouldn't be much difference in the actual premium, right? Again, I'm not an insurance provider. I don't know the exact breakdown, but I would just going off general principles, I would say that you'd probably be paying more for insurance if it was under a business than not. Question asked too here too is, what about if we lease a car? Does it make a difference whether we do a personal or a PREC? So this is also a very interesting thing. We actually did an analysis recently for a couple of our clients. What it comes down to is the actual lease deduction. We try to have it claimed in either case. So basically, it's not like CCA where it's like, if it's in the PREC, only the PREC can claim it. What we try to do is that we still have the lease charge. So to say if you own your car personally, but you have a PREC and you're leasing the car, right? So those lease charges we would still pick up as basically like an amount that the corporation can reimburse you. But the issue that could arise in the event of a CRA review is that they'd want to saying, okay, it's just leased under the corporation or personal. Not to say that they'll automatically deny it, but you have to show more proof to say, yes, this person is actually using this car for business. This is a proportion, et cetera, et cetera. So I would generally say is that if you are, if you already have a car right now, and you're going to set up your PREC this year, and you don't want to transfer everything over, we can still claim up. You can still basically put the same claim as a lease expense compared to having it in the corp or not. But what we just got to watch out for is that, like, if you're saying, okay, I want to lease a car in the next 3 months, I want to open my PREC next month, I would say it would be better to have that lease under the corporation. So if you didn't make that move yet, it's better to have, if you're able to plan for it, have that lease under the corporation or PREC in this case. Okay.
It's just after 3 o'clock, so
yeah, I was going to say,
yeah.
we just stick around a little bit because I know we started about 10 minutes late.
Right.
And again, if there's anyone else in the room that has any questions, you can obviously unmute yourself, or you can post it in the chat box. I know, again, we tried to get this on Facebook Live, but unfortunately the gods of Facebook were not working with us today, so we have to improvise.
I do have one question further to what you just explained around the cars.
Yeah.
So let's say if I were to consolidate my car payments and sort of use refinancing of my home, and that's where I put my my car loan in there, will it, and then move it to the PREC or sell it to PREC and then sort of claim it from there, will that car loan that is sort of rolled into the refinance can that be used?
Yeah, so to answer your question is that if it now becomes a corporate liability, right? Well, what it is that what you will be able to deduct, it's not the actual principal payment, it's just the interest portion. So that's sometimes I think a lot of confusion that arises, because remember, there's a difference between obviously leasing and then like buying and financing. So if you're just simply doing the finance route, the interest portion you can still deduct under your PREC if it's moved over to your corporation. Right. What sometimes is a bit of a complication that I was trying to allude to earlier is that sometimes people don't move their car into the corporation. They still hold it personally because they don't want to do the plate transfer and the ministry and all that stuff. So what it is that the question is saying, okay, could you still technically deduct the interest in that case? And I would say, because it is being used for a business activity, and you're technically being the sole shareholder, you can show that you were paying for those costs. We can still claim the interest costs, but it is on CRA's end, it becomes a little bit more of a delving exercise. They'd have to look into more details, and they may, there may be some back and forth regarding that. When it's owned by the corporation, it helps a bit more, and something we generally recommend, saying if you are claiming any car expenses, you plan on keeping your PREC for a couple of years along with your vehicle, then just have your car owned by, or whether it be owned or leased under the PREC.
And is there, I mean, that's the advantage side of it, and kind of eliminates all this back and forth and sort of with CRA issues.
Yeah.
Is there a downside to do that? Like, is there something that may impact, okay, we need to be mindful of that? Is there any downside besides nothing at this point.
Yeah, no, but it's a good point. I'd say there's a couple things you got to keep in mind. So from a legal perspective, again, I'm not a lawyer, but I would say that when you're having a corporate asset under, so essentially if the vehicle's now become a corporate asset, what that basically means is that, you know, if there is an insurance claim brought against you over if there's a claim brought against you over your insurance coverage, your PREC assets may be on the line because
Liable,
it's a corporate owned vehicle. So it's just something you need to keep in mind there. Generally, I mean, something that I also would advise clients is that if they're having assets that appreciate in their PREC, and then when you sell it, you have something we call recapture. So the CCA which you claim, you have to basically put that back into income. But with vehicles, they depreciate, as we know, unless you have like some antique vehicle that's like appreciating in value. So we don't really have the issue with recapture as much. The only issue that could happen is if you over depreciated more than what you got back on the sale of that vehicle, then you may have some income inclusion based on like what we'll call over depreciated CCA. But generally speaking, there's that. I mean, the only other thing I could think of is that, because you're having an ownership transfer, that would involve getting your plates and registration changed at the Ministry of Ontario for that vehicle.
Another similar sort of tied question to it. So let's say because PREC cannot own any properties, like for example, I can buy properties under that, right?
No, that's true. No, legally speaking, you are allowed to actually own properties under your PREC. What we generally would advise though is that if you're, let's just say, planning on building a portfolio of rental properties, right? It would be better to actually have a holding company attached to your PREC. So what I mean by that is that like you would still open up your PREC to have your commissions go through there, but then you can have a holding company own shares of your PREC. And the advantage of that is that as cash gets accumulated in your PREC, you can actually do a tax-free transfer to the holding company, and the holding company can make those investments in real estate.
Okay.
Right, and it kind of, and not only that, but lawyers would, even some accounts too, would often say that it's always advisable to have the higher value assets, being like houses and stuff, in a separate entity from your operating company, which in this case is your PREC. So that's something where I would generally say, but because I know it was asked earlier, saying are you allowed to have rental properties in a PREC? The answer is yes, you can technically do that as well. But again, if you're planning on building a portfolio, it's best not to have that all in the PREC.
So does that expose those properties in the holding company to liability as well in case of any insurance sort of matter? Yeah,
and again, I unfortunately I can't give the solidified legal advice, but I would generally say that if it's something that, like, so it depends on where the claims are arising from. If the claims are arising from your operating company, from the PREC, you got to keep in mind firstly is that like errors and omissions stuff, that is still technically covered from under your personal insurance policy. That won't change, right? But if it's something that outside of that where you get sued, and they're going after the PREC, usually having a holding company separates out that separate liability, because again, each corporation is a separate legal entity. So unless let's just say the person that's suing you, if they did, let's say, like a search and they found saying, oh, you also own this corporation, and that other corporation is somehow liable, then I guess, yeah, that could be on the line, but it's harder to go after a holding company than it is to go after your PREC directly. And again, I mean, the other thing you just got to keep in mind too is, as I was saying from the beginning, like, where does the claim arise from? If they're suing yourself individually, personally, then technically your PREC is already separate from you individually. So your PREC cannot be sued for whatever happened to you personally, right? And by personal, I'm just giving the example. Let's just say, for example, I use this common one where, let's say you go to a restaurant and you give a bad review, and then the owner thinks that you're messing up the business and he sues you for defamation or whatever, right? So now he's going after yourself personally. But the question is, okay, you have all these assets sitting in your PREC. Do they, could that be an issue too. So it really, you got to look at all the factors. Definitely also consult a lawyer before you take my advice.
Yeah, no, thank you so much. Does that then make sense for us to put the car in the holding company then?
That's a good question. I would say I think having the car under the operating company would be better. And again,
Okay.
it comes down to the fact of like who's going to be deducting the expenses for it, right? If you
Mhm,
have a car in a holding company, then the holding company, unless if it's earning, let's say like active business income as well, you're not going to get much advantage of having the deductions under that holding company, right? It
mhm.
would be cleaner if you have it at least under the operating company or the PREC.
Okay, okay, okay. No, thank you so much. I appreciate it.
No problem. Aaron, I see you raise your hand again.
Yeah, I just have one more question. Thank you. It's actually in relation to the PREC structure.
Yeah.
So similarly to the previous question about owning properties, what's your advice on if a PREC were to own, let's say, investments like stocks or mutual funds? Is that something that would be basically advisable for funds that would, let's say, not be used for become more expenses, and what tax implications would be reflected, let's say, if those make any profits throughout the year?
Right. I mean, I think that's a very good question because and I think it's also very relevant because what we got to keep in mind is that as your PREC, actually, I'm not sure if we lost Aaron there. Okay. Oh, sorry, still there. Sorry, you're still sorry. It's just, it was weird because I think someone left it and all the images got rejigged. It's a relevant question because what we have now is that you have this PREC that's accumulating cash, and you're thinking, well, I just don't want the cash to sit there. It'd be nice if I could put it directly into GICs or stocks or bonds or whatever. We've got to keep in mind is that with firstly, legally speaking, you are allowed to have stocks and bonds in your PREC as well. So you're not prevented from doing that. So the answer is you're legally allowed to do it. The question is, should you do it? What you got to keep in mind is it related to also the point regarding rental properties before is that basically income earned on stocks, bonds, GICs, that's all passive income. So one thing that the government does, it's evil, but one thing that they do is that they do tax passive income at a higher corporate tax rate than they do your realty activities, because realty activities is it's seen as active income, it's seen as an active business, and would be taxed at 12.2%. The investment income is taxed at right now at between Ontario federal combined, I think it's 50.7%. So the initial question,
50,
sorry,
50.7 or 50?
Yeah, 50, basically 51%. Right.
51. Okay.
Yeah. Oh. Yeah. So, but here's the thing. What it is that you have to look at a couple of our factors. So one of them being is that would it always be at 51%? Not necessarily, because what happens is that if in your PREC you're paying dividends to yourself, right, from money that's being earned and is going to you personally, about roughly, I think 30% of that gets refunded back to you as what we call like a dividend refund under the corporation. So that is actually, you do get some of that higher corporate tax that you paid back to you, right? But ultimately, you still have to be paying a dividend to yourself for that refund to be triggered. The other thing you got to keep in mind too is there's an issue now, and I mean, for most realtors where their income is, let's say, under, we'll call it 300, 400,000, you don't really have much of this issue. But what the problem is that they came out with this new rule pretty recently where they actually grind down the small business deduction. So we'll call it every PREC out there on their active income, they get up to $500,000 of net income that gets taxed at 12.2%. Anything above that, you go into the 26.5% range because you lose that small business deduction. The reason why I'm bringing this up is that as you earn passive income in that same corporation, or even if it's in a holding company, it doesn't need to be only in the PREC, that small business deduction limit gets slowly ground down. So instead of, let's just say, and again, I don't have the numbers in front of me, but let's just say, for example, if you're making X amount of investment income in your PREC, instead of having up to 500,000 available where you have the small business limit, it may be down to say 450,000 or even less, right? There's a certain grind. I can't remember if it's like $50 for every dollar.
It's at if you've earned passive income in that company, and as you mentioned, any associated companies, which would be your directly held holding company if you had one, any income over 50, passive income over 50,000 will grind down the small business deduction at the rate of $5 for every dollar of passive income.
It's not as bad as I thought. It's $5 for every dollar. So exactly. So in this case, if you have $100, and in theory, you're going to have $500 less that you get to claim under the small business limit.
But you do have to have that passive income in the group over $50,000 on an annual basis. If you're making less, you don't have the grind. But if you're nice and successful and you're making that passive income at a level higher than 50,000, you're starting to impair your small business deduction, which might have been part of the raison d'etre of having the PREC.
Yeah, we've actually, Aaron, just also mentioned, we also did a recent kind of calculator, or actually I kind of constructed, which kind of goes to this scenario where it says, okay, you buy this, stock, or you sell it or whatever, what would be the overall tax impact having it in the corporation versus not? So we kind of use the same analysis for rentals, but really because rentals and stocks and bonds, really they fall within the same scope, as much as they are very different, the tax treatment's the same. We can do that analysis for you as well for your specific situation. So my answer to this is it really depends on several factors before we can say that there's an advantage to holding the real estate investments inside the PREC or any other holding company for that matter too.
Thank you, Stephen.
No problem. Okay. Right now it's at 3:18. I guess we're going to start winding down. I don't know if anyone, Neil, did anyone post any other questions to our group?
No, that was it.
Okay.
Yeah.
If anyone else in the group has any other questions, now is a great time. As I said, what we'll do, because we try to get this on Facebook, we'll save the recording and people can watch it after the fact. But for those who did attend, thank you very much for attending. It was very appreciative. And thank you for your input.
And feel free to reach out to us. You can visit our website, RealtyTax.ca. Realty tax.ca.
Yeah. One good thing with our website is that we are posting articles on a weekly basis on real estate related tax stuff in general. So feel free to check that out. If you're not subscribed to us, feel free to also be subscribed for free, and you can also get access to that articles along with any useful information that pertains to realtors in Ontario.
Thank you.
No problem. Okay, so I guess that concludes our presentation. Again, thank you all for joining, and I hope you all have a great day. Take care.
Thank you.